Yes, surely.
1 second, sir. I'm also starting the recording. I think recording is started. Hello, everyone. On behalf of the Finance Club IIT Patna, I welcome you all to the guest lecture talk. Today, we have Mr. Chander Bhatia as a guest lecturer, who is the Chief Investment Officer at Seers Fund Management Pvt. Limited and has very deep industry experience of around 30 years. Today, he will share his insights on behavioral aspects of stock market and key learnings over these years. The audience members can raise their hands at the end, where I'll ask them to unmute themselves one by one to ask their questions. Over to you, sir.
Thank you so much for the introduction. So I'll just start with. So I have experience of all the three aspects of equities. One is as an investor, second is as a trader, and third is as a fund manager. So I started small with a small amount sometime in 1991, and then still I'm an investor. And then I also traded for 15 to 17 years, almost you can say from 2000 to 2016, when I decided to quit the trading business and to focus on fund management side. So today I will speak about what is the importance of behavioral aspect for as an investor, as a somebody may join as a fund manager, or everybody will be an investor, I suppose, because investing in one thing which is key for everyone to be a part of that. Their capital should grow, because this is the only way to beat the inflation. And in other terms, I can say that your money should work for you, and over a longer period of time, you should able to increase your purchasing power. So I'll just give a disclaimer first that whatever stocks I will talk about, it may not be considered as recommendation or a buy or sell call, because it is purely for educational purpose. So we are a SEBI registered PMS company. So we have to follow these guidelines that whatever we share information and details, it is all about informational and educational purpose, except whatever detail we share with the clients. So I will start with this next slide, which is about, so first it will be about subject layout, what all I will talk about. And I will try to keep it brief so that you can ask more and more questions. So I would be, I like more of an interactive session. So I will keep it brief, maybe 20 minutes, maybe 25 minutes, or maximum to 30 minutes. I will not go beyond 30 minutes. So I will be talking about what all investment options are in front of you. Then second will be, what is my investment experiences so far in the long journey of 3 decades, and what are my trading experiences, then my experiences as a fund manager. And then I will talk on a very critical topic, which is about what is more important for investing success, whether it is IQ or it is your emotional intelligence. So that is one of the most critical part to create wealth over a longer period of time. Then I believe everyone is a young professional here, and my presentation is for the young professionals, because for older people or people who are above the age of 40 and 50, there is a different plan for them, but for young generation, there is a different way to look at the investments. So I'll categorize those investors into 3 categories, and then I'll share some very important facts about equities. And last slide will be about compounding table. If you invest into debt, if you invest as a investors, risk-averse investors, what kind of return you can expect. If you invest completely into equities, but as a diversified investor, and if your style of investing is entrepreneurial type of investing, which is my style, so which needs a different mindset, a different passion, and I will discuss when the slide comes. So now you please can come to the next slide. So primarily there are four now people say, but in my view, it's only three type of instrument which one can own. One is debt. Everybody knows about FDs, uh, the debt funds, then about that PF, Provident Fund. So these all are the debt instruments. And one very important aspect is there that most of us talk about that debt is safe and there is no risk. So risk, generally what we define risk is the uncertain outcome. But there is certain known things also which have a risk. So I'll just ask this: what do you think debt has a risk? So some participants, later on I'll discuss about it when Q&A session is open. I'm asking these questions: what is the risk in FD, known or unknown? So that I'll come back later on. So debt generally is basically for young generation is to keep some money for emergency purposes. Beyond that, with the perspective of returns, young generation should not invest into the debt. It's only for emergency purposes. And secondly, if somebody have short-term financial goal to meet, maybe 1 year, 2 year down the line, they can keep their money into debt. Then I'll come to equity. Equity is one thing which have a natural tendency to give you higher returns than nominal GDP over a longer period of time. Equities are volatile, and because of volatility, the reward is higher. So I'm completely the equity investor. To your surprise, I have never made a FD in my life. So from day one, I am investing entire savings into equity, and that is the reason why my money grew to multifold level. My return has been superior. Again, I'll come back on this later, because here I want to tell you what kind of possibilities are there into the field of equities and what type of returns you can expect depending upon two or three critical factors. One is you need to develop a investment philosophy. Generally, it takes a time of 5 to 8 years to make your own investment philosophy. Every investor need to have an investment philosophy, which will depend upon their risk tolerance and risk appetite. So that is how one has to make a investment philosophy. To be a successful investor, you need to have a investment philosophy. Then I'll come to I'll talk more about equities later on. And now then the physical assets. There are two main options. One is gold and other one is real estate. At early age, young investor should not focus on real estate, because that will be generally, I recommend whenever you have a good surplus amount, you can go ahead with your first need of is the housing need. So if you invest into the house, that is always a good thing, but after having certain accumulated net worth. Gold, I'll on a this thing lighter side, gold is only to give to your girlfriends, not otherwise, and to give your other dear one, sister, mother, and likewise. So basically, gold is with the objective of, earlier it used to be considered as insurance when the insurance market was not developed. Still, some part of India or rural and semi-urban areas, still it is considered it as gold is as insurance, because whenever they have major need or expenses, they are ready to sell their gold. But now gradually that is shifting, and gold is just for the purpose of ornament, and most of the people are gradually shifting towards the financial assets. It will take still next 10 to 20 years, because this is a very slow process. With the change of the generation, it changes. It doesn't change in 1 or 2 or 3 years. Now, a lot of young professionals or students are into cryptocurrencies. What it is, till date, I could not figure out whether it is a currency or it is an asset. If it is an asset, what kind of asset it is? So you talk any of the senior investors, they will talk what cryptocurrencies, we don't know. So from my side, cryptocurrency is completely a no asset so far. After 20, 30 years, I don't know how it will pan out, but it is not a currency. It cannot be termed any asset. Some people compare this asset with gold. Gold has 400-500 years of history, or rather more than that, and it is used for ornamental purposes. Some industry also use a small part of gold as their raw material. So cryptocurrency is completely a no-no. Still, somebody want to ask some questions, they may ask later on. Yeah, next slide, please. So yeah, I will share some of my investment experiences, which was a very different kind of experiences. So my first mistake or learning was from Infosys. I bought Infosys sometime in 95, 96, and I allocated a good amount of money to that. Reason being, I used to read a lot of newspapers. So luckily, I could access to Financial Times, which was coming from Singapore. So I read 4 or 5 articles about that software industry, and they said that Infosys is one company which is likely to grow multifold. On the basis of that, I bought Infosys, and I put a few lakhs rupees there. Almost 30-35% of my capital was allocated to that. And the first experience, large investment experience. Before that, I had a small experiences with different companies. There were some gains, some losses, but Infosys was my first biggest gainer. So as soon as I bought it, within a few months, that share went up like a rocket. I never believed that shares can behave in this fashion. And that time I was working as custom preventive officer. Till 2000, I have worked as custom preventive officer. After making a good money in this equity market through investing, I quit that job. So I worked there as 9.5 years from 1991 to 2000. So when I bought Infosys, I never thought that it will give this kind of returns to me. And within 3 months, that share doubled. I was amazed to see the rally, and again it started moving up. So I was so excited that I started selling that share when it became double, and within, say, I might have made around 150% profit on that particular transaction. So that money was much more than my annual salary at that point in time. So that was the first reason I decided to quit the job. Then today, if I see Infosys from 95, 96 till date, it is more than 1500x. It means if I would have kept that investment as permanent investment, it would have generated me a return of 1500x. 1 lakh rupees would have converted into 15 crore rupees as on date. So that is the power of right investment. It does not mean that you will able to catch so many right investments, because it is a very tough field. It is not an easy field. So that I keep sharing my experiences through Twitter and LinkedIn also. So it is one of my biggest mistake and biggest learning, because I never knew that companies can grow that multifold. Then next is Shri Cement. I bought somewhere in 2000, 2001, and it was around 45 rupees. So everybody knows the rate of Shri Cement is more than 22,000 rupees. I kept on holding this share almost for 2.5 years or so. And it was just in a range. It was not moving up at all. And after 2 years, I was just tired bull. And I sold it at the same price. It went down to 35, 30, 37. It was just in a range bound. I sold it at 45. I waited for 2 years, sold it at the same price, because I became a tired bull. So far, my analysis was saying that this is a company which is the lowest cost producer in the Series Cement, but I could not hold that stock. And today, that share is almost 550x from my selling price or buying price, because it was almost the same. So that was the second biggest learning for me, that how good companies over a period of time can compound your wealth. Then third is unsold properties. I'm sharing different experiences, what I did, how I thought it, and what was later on the result. So I will share I will join Ansal Property with the fifth name, which I have written as name withheld. Reason being is I am still holding that company. So because any company which I am holding, I'll not share the name of that company because it is I think is ethical from our side. Though SEBI's regulatory guidelines says that we can share, but we can give the disclaimer. It is not a buy recommendation or sell recommendation. So I'll just club Ansal Properties and the name withheld company, which is a textile company. Ansal Property was that time there was a big boom in real estate. Now second time the boom is coming in real estate after almost 15 years or so. So I just bought a share at around 400 rupees, and it came down to 380. I kept on buying for 1 month or so, 380, 390, 400, 410, 420, 430. I kept on buying for 1-2 months. After and with the analysis of that this company should give me 3x in 5 years. Generally, I calculate that wherever the possibility of to generate 25% CAGR, I would like to invest, or in other terms, any company which can do can double in 3 years. That is my objective to invest because I generally pick mid cap and small cap stocks. So Ansal Property I bought with a perspective of that it should triple in 5 years. And luckily, that share after a month or so, when I have accumulated my quantity, it started moving up. And within 4 months, it became 3-bagger. So I just was amazed again with this journey, and I just started selling. And within next 6 months, I sold my entire quantity at 3x, which I thought it will give me return in 5 years, but it had given me in 3 to 6 months. So I just quit that. Then I'll attach this company with the name withheld company. This company I bought in 2007 and 8. This is so far one of my most successful investment. So I bought it at 120 in the fag end of 2007, or if some people know about the credit squeeze crisis or Lehman Brothers crisis or subprime crisis. So that is struck in the first quarter of 2008, and all the markets globally crashed in a big way. So this stock also went down. I bought at 120. If I adjust to split, it is 12 rupees share because it has now 1 rupee share. That time it used to be 10 rupees share. It came down to from 120 to 22 rupees. So, but I was sure, I was very confident about this company because I visited factories and saw their facilities. So it was a very interesting company. So I did not get panic at all. Panic I don't get generally. I've never into panic situation except once into a trading situation. So I kept on having this company, did not sell any stock. Next 6 years, the stock was in the same range. Means it was in the range of 120, 180, 140, 160. Profit tripled in this period from 2007-8 to 2013-14. Profit tripled, but share did not move up. So again, it was a very different kind of experience that your analysis to that top line is growing, bottom line is growing is correct, but share is not moving up. It tested my patience like anything. 6-7 years, no return, profits are growing. Every time I expect, every quarter result, performance is better. Company is doing well, company is expanding. So why this share is not moving up? But share was not moving up. But I did not lose my patience. And in 2014 to 17, this share became 16-bagger from my buying price. I sold partly, and that was one of the great experience. I sold it partly, I kept it partly, half of the quantity. And again, from 2017 to 2020, this share did not move up. From 2020, it went up again like a rocket till date. So it is a 60-bagger for me. Now, right now, after correction, it might be 50-bagger. I sold at 60 times, 65 times, 70 times, 55 times. Still, I'm holding a large quantity. So what I mean to say, in one company, I was calculating, I'm talking of Ansal Property, that share will triple in 5 years. It tripled in 5 months. Here, I was thinking that share will triple in 5 years. The profit tripled, but the share did not move up. So equity market have a very different kind of scenario or movement, which we don't expect. But the core of this discussion is that we have to continuously to focus on the business side. If the company is growing, profits is growing, sooner or later it will be reflected in the stock prices. Kale Consultant, I'll just share in brief. I bought a huge quantity in 2006-7, 2-3 years. This share did not move up. We were meeting managements, we were discussing with them. Things were okay, not great, not bad. This share did not do anything. Then we got tired of. We sold it, bought at 110, 120, sold at 65, 67. Then that share in crisis went down to 20 rupees. So I was happy. I've sold it at a loss, though 40-50% loss I took. From 20 rupees, that company was taken over by a French company. Now the name is not Kale Consultant. You can Google it. So from 20, it went to 1600 rupees because of it was taken over by the French company. I did not mind because I made a good money. I quit it. I did not mind because I invested that money into this name withheld company where I made a huge money. So now I'll just talk about Aarti Industry. Same thing happened. I bought it adjusted to bonuses at 11-12 rupees. 2-3 years down the line, I sold it for double to triple profit. Today, this company is almost 60-70x. So again, I missed that opportunity. That chemical sector will do very well. So I never thought that good it will do. But again, I made 3x in this and then reinvested that money. So there I made money. So net what I want to say is that you have to focus on the businesses side. Stock market will not align to what the businesses are doing. The stock market will always behave in a different way. So once you want to analyze anything, you have to think, not always link the stock prices to business performance in a short run, 2, 3, 4, 5 years period. In a long run, always stocks will reflect what is the profit and cash flow growth. That will always happen. But in a brief period, 3, 4, 2 years, it may not happen. Yeah, next slide, please. Yeah, trading experiences. So sometime 22 years ago, I made a good money in software bull market, and I bought a company. I'll not name that company, at 600 rupees, almost equivalent to what was my net worth. For example, suppose my net worth was 25 lakhs. I bought shares of almost more than 25 lakhs, maybe around 30 lakh shares on Wednesday morning. That time settlement used to be 7 days, and there used to be a downward freeze of 8% only that time. So I just bought it in a trading frenzy, and after a few hours that share freeze downward. So it was a day Wednesday, because the settlement used to be from Wednesday to Tuesday. So every Wednesday, whatever you buy, you have to settle by Tuesday. If you sell it by Tuesday, you have to just pay mark to market losses, or you will get that. So there was no that you have to pick the delivery. But if you are not able to close the delivery by Tuesday, you need to make the full payment. That was the rule. So those who are trading, they must be aware of. So I bought Wednesday morning. After 2-3 hours, it freezed downward. So I bought around 650. By the evening, it was 590 or so, 8% downward freeze. So I thought no problem. I used to trade. So I used to make money. I used to lose money. That was a part of the game. Then again, Thursday morning, that share opened downward freeze 8% further. So 590 share went to almost 540 or so, 550 or so. Again, there was a huge loss to me, but it was still okay. I was able to bear because I had a good cash keeping with the broker so that I can handle that. Again, Friday morning, it opened downward freeze. So now it was a stressful situation for me, because next 2 days were holidays, Saturday, Sunday. And again, that 2.5 days pain I have to bear. Still, I was able to manage that because I was having that kind of cash. Monday morning, I was praying to God that it should open, at least it should open. It should not open downward freeze. Monday morning, again, it opened downward freeze, another 8% loss. So almost I lost 30-32% in 4 days. If I calculate Wednesday, Thursday, Friday, and Monday, 4 days downward freeze, almost 30-32% I lost that money. And it was, I bought the quantity more than my net worth. So then it was a stressful situation because I have to make the payment. Then I just saw what all shares I have in my portfolio. 50% of the share I sold from my portfolio at any price because I have to pay to the broker. Because now cash was over by Friday and I'm not sure whether it will open on Tuesday or not. So again, a very distressful day. Then on Tuesday morning, again, it opened downward freeze. So now you can think of 5 days, I've lost almost 40%. And I have to sell my delivery at lower rate because when there is a pressure in the market, the share also come down. I have to sell a lot many shares. I sold a lot many shares. And then again, I have to make the delivery payment then. So a broker was adjusting. So there was some small shortage. So he got adjusted. But no problem, we can adjust on Wednesday or Thursday. Wednesday morning, again it opened down. Sixth day downward freeze. I've lost 50% of my money. And I bought quantity more than my net worth. But luckily, Wednesday evening, it opened from downward freeze and it went upward freeze. So that was the biggest relief for me in my trading career. So I got a lot of relief because 16% I recovered in a day, 8% downward. Then it came to the same level and then 8% upward freeze. Thursday morning, again, it opened to upward freeze. So I could get back my 50% of lost money because 16% plus 8%. Sorry, excuse me. So that was a very, very tough trading experience for me. So those who trade, it's not an issue that I want to scare you of anything, but I want to inform how the things happen in the market. But leveraging is a very, very dangerous instrument, but a balanced leveraging can be done. So again, then, just a minute, yeah, please. In 2008, market crashed globally. So what happened at that point in time? Gold, people have started buying the gold. So gold went up. It was never crossed, gold never crossed $1,000 at that point in time. It was 900 or so. And when there was a frenzy, so people started buying. Some good investment bankers, some good advisors started buying gold. So gold started crossing the $1,000 level, which it had never crossed. Now it is around $1,800. So now it is $1,800. So I analyzed the silver and I bought silver somewhere around 22,000 rupees in India. And within 18 months, it went up like anything. And I kept on holding my position and I made a huge profit in silver trading in next 18 months. So my money almost tripled, whatever the leveraging I took. So that was a bountiful returns in trading. So one is a very bad experience, almost near bankruptcy situation, and one was a bountiful return. And that time all equity shares were going down, so I could make a huge money in silver. So yeah, next slide, please. Srinu.
Sir, is next slide visible?
Yeah. Hello.
Yes.
So next slide, please.
Sir, is it visible? Next slide. I have changed maybe network problem.
No, it is not visible. I can speak. It is visible to everyone. Yeah. Hello, Madhur.
Sir, I'm just
no,
trying
sir.
to.
No, sir.
So I can speak otherwise also. Now it is not. I don't know why it is not visible. So next slide is my experience as fund manager, and I can share. I can talk about it. So I'll just start with that. I'll continue. Everyone is able to listen. If I'm not wrong.
Yes, sir. So voice is
Okay. It's okay. So how did I handle my clients during pandemic situation? Because people got panicky, and I just started fund manager role sometime in 2017, and then 18 onward market. Particularly, we are a mid cap, small cap investors. So 18 was a tough period because of LTCG was imposed. 19 was also a dull period, and 20 then the pandemic strike. So people got jittery. My client got jittery, and obviously nobody knew what is likely to happen in COVID. So, but still we could manage because we always take clients who want to be with us for at least 4 or 5 years. So we convinced if someone want to go, someone want to exit, they should not exit. So people just kept on believing us, and people kept on believing us, and they, yeah, now it's visible to me. I think it is visible to everyone. So people believed us, and they kept on at least hold us up. But some people left also after 6 or 8 months, that they were not happy with the returns. Now those people repent also, because now the returns are superior. So clients are very happy with you when your performance is robust. You keep getting the flows when the performance is robust. And as soon as the market starts trading downward, or even your performance are coming down in absolute terms or benchmark wise also, people would not like to put money. Equity market is one place where people love to buy at premium. They don't want to buy at discount. So that's a very unique feature of equity market. Though it should be otherwise, in every sale, people will wait for the sale, and on a major sale day, they would like to buy a lot of goods. But in equity market, when sale is going on, people are not interested to buy. Those investors who generate higher alpha are generally those who want to buy during the sale time, or they would continue to hold their investment during the sale time. So this is a very critical point, that those who have guts because of their analysis, because of their knowledge, and because of their conviction, and those who buy during this time when these shares are available at discount. Somewhat discount has come in last 2 months. So those who buy this, they make a lot more money than usually those who buy during the premium time or momentum time. So yeah, next slide, please. Yeah, so every one of you must be having a good IQ. Obviously, all are in IIT Patna. So to understand the reasoning, logic, applying those understanding, and predicting, forecasting is one part of the equity, which many people can do it successfully. But emotional intelligence is much more important. Reason being, to be disciplined, to show patience, to be having imposing self-regulation, to be not to be nervous, to be not to take impulsive decisions. Because what we have observed, that most of the bad decisions, even by intelligent people, are taken due to fear, panic, or major drawdowns of equity market. So those who have a better emotional control, or those who are emotionally intelligent, they are able to glide through or sail through rough patches easily, and at the same time they are able to enjoy the higher profits or superior profits or robust returns. So for to earn robust returns, the emotional intelligence is much more important than IQ. So that is one aspect everybody needs to understand, and everyone needs to try to start following that. If someone is doing that, then it is quite a good thing. So next slide, please. So there are three type of investors, young investors particularly. Entrepreneurial type, those who calculate, those who understand the businesses very well, those who take the concentrated bet, those who just focus on 8, 10, 12 businesses, where they think that these are available at a huge discount, and over a longer period of time, that discount will convert into the premium. So those who take a concentrated risk after understanding the businesses, to those investors, I categorize as entrepreneurial type investors. Second is a diversified equity investor, those who remain into the equity, but basically they want everything, whether it's a global equity or whether it is a large cap, whether it is a mutual fund, whether it is a small cap, they will remain into equities, but they would like to diversify a lot. So generally their performance will come to the market performance. They would not able to make a lot of alpha, but they are likely to make what the market gives them, whether global market or Indian market. Third is risk-averse investors. Investors who want to put not more than 50% equities. and largely into the large cap. They are risk-averse investors. They will put 50% somewhere else and 50% in the equities. So their return will tend to be lower. So I'll just, if you ask me to categorize the returns, those who are smart, intelligent, entrepreneurial type investors, they can generate somewhere between 21 to 27% return over a very long duration, say 10 years, 15 years, 20 years. Those who are diversified equity investors, they can expect in the range of 14-15%. And those who are risk averse, they can expect in the range of 8 to 10%. So yeah, next slide, please. Yeah, next slide is about compounding table, and this is the last slide. So I'm not able to see that slide so far. And this is one of the most important slides to understand how the equities over a longer duration can generate returns in terms of a investor who invest only in debt fund or FDs, or a investor who invest in a diversified equity, or a investor whose style is entrepreneurial type of style. So that slide is very important. If it is not able to come, then everyone should read it later on. Madhur can share these presentations with everyone. Madhur, are you able to show that slide, compounding table slide?
Sir, is it visible now?
Yeah. So those who invest in FDs or debt fund, they are generally earn in the range of 5%. So you can see in if 5% return in 10 years, first I'll come to 5 years, it will be 1.27. It will generate less than the inflation. Or if we calculate the taxes also on that, because those who earn high income, they need to pay 30% tax in FD, and that fund it is 20%, and depending upon the period of holding that debt fund. So 5 years it will be 1.27 times, 10 years it is going to be 1.62 times. At the same time, somebody who is earning 12%, in 5 years it will be 1.76 times, in 10 years it is going to be 3 times. Likewise, 15, in 10 years it will be 4.04 times, at the rate of 18 it will be 5.23 times, and at the rate of 25 it is going to be 9.31 times. 10 years difference is not that a great difference. If we see 15% to 25%, it is 4.04 to 9.31. But if you go forward in 15, 20, 25, 30 years, the difference is going to be extremely huge. A person who invests for 20 years in FD will just make 2.65 times, which is obviously going to be much lesser than what that purchasing power will reduce, because inflation will be around in the range of 6% or 5%. More than FD rate will be the inflation. Plus, if we adjust the tax, then further it will reduce your purchasing power. And the same person who is doing at the rate of 12%, it will be 2.65 times to 9.64, then 15%, 16.36, 18%, 27 times, and 25% is 86 times. So this is the way the compounding works. That's why most of the people say that compounding over a longer duration is one of the most robust concepts. So you can understand the longer duration. Many of the young generation will say, what will we do with the money after we become old, say after 20 years, 25 or 30 years? Money is always helpful, or money is one of the main medium which will solve your many problems. So at every age, the aspiration should be to earn money, not in a manner that every full flash you are going so aggressive that you are living your balanced life. So I always recommend be a balanced person, be a focused person, be a person who understands what is your core and focus on your core. So automatically, if your process becomes better and better, your returns will become better and better. So follow the process, understand yourself, your risk appetite capacity, make your investment philosophy, and that is how you can do very well in the field of investment, whether as an investor or as a professional in the field of fund management or analyst or investment banking, any of the field. So yeah, thank you. This is I'm done, and now Madhu, you can start with question and answer.
Thank you, sir, for the presentation. Now we have collected some questions, after which individual audience members can also ask their questions by raising their hands one by one.
Yeah.
Sir, many people says that it's better to be mostly invested in the market throughout instead of sitting in the cash and waiting for some big correction. So, like, how did you manage the investments before just before COVID, when the market fell a lot, and then is invested during the around the bottom of the market and maintain some of the investments throughout, even it was a very sharp V-shaped bull run?
Yeah, that's a good question. So, luckily, sometime in February or March 2020, before the COVID, government announced that on 1st February, that dividend will be taxed in the hand of the investors. So it means earlier companies were paying taxes, which is known as dividend distribution tax, which was around in the range of 19-20%. So when the taxes will be in the hand of investors, so it was coming for all the investors who make more than 10 lakhs as dividend at that point in time, need to pay 33-34% tax. So what companies did, they announced higher dividend or advanced dividend in the month of February, March. So in that bracket, all our clients got good money through dividend in the month of March. So we had a surplus money with all the clients, and then our dividend ratio was huge. So we all got dividend and we invested during that pandemic phase. One thing I was sure of, that people were saying that अगर हमारे को कुछ हो गया, if we die because of this, what will happen with our money? If you die because of this pandemic, whether it is into the equities or in the gold or FD, does not matter. So why not to take a calculated risk, because prices are so low, there is so much of fear, there is so much of panic that every individual want to sell the stock and there are only very few buyers. So we were very aggressive because we got dividend. And luckily, I got a huge insurance policy got matured in the month of February, March. So I got additional funds. So I deployed all the monies what we got, except whatever emergency funds I maintained, that I kept on maintaining. So we invested the entire money in the month of March and April, whatever we got this surplus. And thereon, then we are always fully invested. So, but we convinced few clients, they got convinced, and they have further put the incremental funds into the business. So we deployed that money for work, and then it became multi-bagger from there. So yeah, I think I am clear about this question.
Yes, sir. So another question is that usually people get troubled by trying to catch the falling knife. So they when some stocks started correcting by a good percentage, like we seen in last few months, like after 30-40%, they started trying to buy, and the stock keeps on falling and falling. And ultimately, like sometimes it happens, the stock falls around 60-70%, and then they don't have any more money left to invest, and the valuation seems very obvious to invest. So how one can navigate those kind of situations cleverly?
This is an excellent question. How do we navigate? We keep on analyzing every company on a rolling basis. Means, first of all, we don't take a view less than 3 years. So suppose I'll just give an example, a company which I bought at 8p, for example, or 10p, because of bull market, it went to 30p. So, but average P in my view is say to 15 times or 18 times. So it is trading at a premium now. It means that I may go wrong because companies behave in a very different manner. a company which I bought at 10 P, and I think it should be a average P should be 20 times, but it went to 30 times. So it does not mean that it will come back from 30 times to 20 times or less than that. It may go to 40 times, it may go to 50 times, it may go to 60 times, because market is crazy. Sometimes market behave in a crazy fashion. So how do we do? We calculate on a rolling basis. Whenever there is a huge price movement, or after every year, we calculate on a rolling basis which company is trading at premium, which company is trading at discount, and what is their average P should be. So that chart we keep ready. So suppose some company is trading at 50% premium to our calculation, we will start pruning that stock. And some companies trading at 10, 20, 30, 40% discount, we will start buying those shares. But when the market goes down, you are right that all the your P ratio will go down. Suppose average P ratio is 25 times of your portfolio. If market goes down, that average P ratio will come down to 20 or maybe 18 or 17. That time, what you need to see is which company is still trading at premium, or which company has got a huge discount. So you can churn a little bit in that. But your focus should be on a rolling basis, 3 years, 5 years, 8 years down the line, where this company can be and where the share prices can be, on the basis of your own calculation, or on the basis of your calculation, what should be the intrinsic value. So whatever is trading at discount, you need to add. Whatever is trading at premium, you need to prune. So if you will follow this particular discipline, number one, the calculation should be near correct. Nobody can calculate everything correct in the stock market. If your calculation is near correct and you are following this process, buying at discount and selling at premium, and churning all the time whenever you think it is required. And when I say you have to sell at premium, then on a significant premium, because market swings in valuation game from under valuation to normal valuation to overvaluation, and sometimes extremely overvaluation. So it is a pendulum in valuation, pendulum in stock prices. So you have to calculate, you have to be a prepared mind, you have to think which is at premium, and accordingly you need to churn the portfolio.
Sir, a follow-up question on it, that apart from using a PE ratio, do you think other ratios like price to cash flow, EV EBITDA, or discounted cash flow model are useful while doing valuation?
Yes, in my view, if you follow the cash flow method, what cash flow the company is generating today and how much you want to value, or net profit, depending upon the investment and other things, that is quite a complicated thing. So for that, a lot of explanation is required. But on a broader basis, you need to calculate on the basis of net profit and cash flow, and how it is valued today and what it is likely to value in future. But one thing is that calculating of cash flow is little because you have to follow a lot of forecasting techniques, because discount rate now, say in last 3 months, discount rate has changed. At what rate you will discount. So these things are little complicated, but it can be done. So yeah, the other parameters need to be seen. But one more important point is there, that this is a general rule. But you have to, if you have a deep insight about industries and companies, for example, right now, green is such a concept that it will continue to grow for 20 years or so. So if you can pick a company in green, then you can value it higher. Even at 50p, I'm okay with a green company where I believe that this company is a global leader, and 20, 30 years there is likely to be growth. So it's not only about valuing on the basis of the P ratio, but what company is doing, how long sustainability is there, how much strength this company has. So every company, every sector needs to be given a different P ratio.
So one very common problem that we face, that once we see a stock that rose by a few good times, like as you said in the example, by 100% or something, then we sold it, and many times it happens that they go on to become a mega bagger type examples. Like I invested in Borosil renewable company during the COVID around 30-40 price, and sold it later around 70, because for few months it was very stable around that point, and I just started my journey in the stock market, and just few months ago the stock reached around 800 levels. So
yeah,
how do you think that one should tackle those situations?
Yeah, that's a very important question. And that we did the company, which I am not disclosing the name of that company. We are doing the same thing. First, we sold at almost, because I had experience of Infosys and Chiri Cement and Aarti Industry to sell it earlier. So that company I kept on in my portfolio. First time I sold it when it became 8x. And then I again held that stock for 4 or 5 years. And now I've sold it for 50, 60x. And still I hold a large quantity because I believe that it is going to be another 10 bagger, not in 8, 10 years, but in the next 15 years. So you have to see that if a company has a potential, lot of potential, so you need to sell partial. That what benefit it gives. Suppose in next 1 to 3 years you get an opportunity, then that share comes down, and still you think that that company has a lot of value, you can add that company. So wherever you are bullish with a perspective of 10 years, or you think that it can be so many baggers, then you need to sell only partial quantity. You need to hold the partial quantity with you, because that will help you in both the ways, because you have taken out some capital, you have taken out some money, and then you are able to hold the other stocks.
Sir, how important do you think one should focus on macroeconomic factors like the actions taken by Federal Reserve or international geopolitics or the demand supply things? Because we listened that Warren Buffett doesn't take bets on macroeconomic factors, as he says. But on the other hand, we have Ray Dalio, who is world's topmost macro investor.
Yeah, that's a very good question. I also don't believe that macros helps much, because of so much of macros and variables play in a different way, because a stock is not impacted by macros only. What the company is doing, what the management is doing is far more important. So what I will suggest that you just focus on the company. Suppose you are bullish in a, say, particularly infra company, construction equipment company, and you think that that company is likely to grow multifold, whatever your thesis is. So what you can do that, though the company, you have to focus on the company, quality of the business, quality of the management. Then you have to see if the macro factors, how that will be impacted to the company. So what you need to do is just see that government is spending on infra side. If government is spending on the infra side, is government spending on the infra side, how it is likely to pan out, or how the capex good cycle is likely to pan out. So you see those macros, not the through the macros you invest, but the companies where you have invested or you like to invest in those companies, how the macro can have the impact. So I see in that way, not that interest rate have increased, so what companies will be likely to be one should buy or likely to one should sell. I see my own companies at what valuation they are trading and how those macros may impact that particular company.
So which sectors do you think could have a very bright future as per their economic cycle in recent upcoming years, like maybe real estate, financial sectors, etc.?
Yes, that's a very interesting question. So in my view, because government did a lot of reforms, I can name a few like GST, IBC, reduction in corporate taxation, PLI schemes, China Plus One, Make in India. So India has never experienced a big boom in manufacturing. So manufacturing and infra looks to be extremely good for next 10-year perspective, because structural reforms has been taken place in this sector, and a global supply chain issue is there. Globally, there is a lot many now trade wars or war is going on. So deglobalization is happening, if I say in other words. So it means the companies which will have India exposure, particularly on manufacturing and infra, they are likely to grow multifold in next 10 years. Second theme I like is primarily the mutual fund industry, which has just started, which is just at an inflection point. Only so far 5-6% Indians are investing into equity. So in my view, in next 10, 15, 20 years, that ratio will increase dramatically. So that industry looks good. So these two particular themes, particularly manufacturing, infra, and mutual fund industry. And right now, the financial community is not very bullish in this segment. non-lenders basically, whether it's a wealth management, whether it's a brokerage business, whether it is a AMC business. So people are not very bullish, but in my view, we are just at an inflection point because in 30 years, Indian mutual fund industry started in 1991, and now it is reaching 39 lakh crore. This size will become 3-4x in next 10-12 years. So this industry looks to be interesting. And third is one can look at green, but only profitable companies, because green is a very wide concept. So we are bullish on green also, and particularly a company which is globally competitive. It is not a Borosil Renewables in any case. It's a different company. So these 3-4 themes looks to be extremely good.
Sir, can we extend the session for 15-20 minutes more? If
Yes,
you are
yes. Yeah, you can.
Thank you, sir. Sir, already due to China plus one strategy, we have seen a very tremendous bull run in the chemical companies in recent 4 to 5 years. For example, in companies like Alkyl Amines, Balaji Amines, Deepak Nitrite, etc. Do you think that there could be a still very bright future for this sector in India in upcoming 5 to 10 years?
I will avoid naming the companies and commenting about the company, but in my view, I may go wrong. Chemical sector is now overvalued and it is trading at 30 to 50 P. So I'm not personally comfortable with chemical sector, because RC industry, which I missed the opportunity, I bought when it was trading at 6 P. Today the profit growth has not been huge in last 10-12 years, but P has changed from 6-7 to 30. So P ratio is higher, expectations are higher. Whenever little bit dent in expectation will happen, it will have a huge drawdown. So in my view, I'm not bullish on chemical sector, but you can take your own view or call.
Sir, how do you start analyzing any new mid cap or small cap stocks? Because at that time we don't have like usually people see the past trend of their net profit or revenues or ROE, which usually isn't very promising for new companies in mid cap and small cap sector. So you shared the examples of so many companies that you invested very early on. So
Yes.
any suggestions how one can approach that?
That's a very interesting question, because what we need to see, you can generate better returns or higher alpha only if you pick in the early cycle. So how do I go about it? I just analyze different sectors, what happened in last 10 years. If whichever sector is underperforming in last 10-15 years, you have to just start looking at it. So what happens when you start looking at the sectors, because those are undervalued sectors, people are not bullish, shares are not overowned, and nobody's talking about it. So there you will keep getting a great picks. Then further analysis depending upon what the management is, what the business is doing, how much they have done during the bad phase. Because anyone who does good in bad phase do excellent in the good phase. That is how this market happens. And you get much under, like for example, now you see the pharma industry. Generic players are not doing well in last 6-7 years. From 2008 to 15, generic players were doing very well, like Sun Pharma, Lupin. This is all for example. Sun Pharma, Lupin, Dr. Reddy. From 2015 onward, these companies are not doing well. So anybody who can find a good generic play, 6-7 years down phase, you can see the other way around. There are many other. Now banking is not doing well. You can pinpoint some good companies in that. So anything which is not doing well in last 5 to 8 years should be your way of analysis. If you want to be a long-term investor, you want to generate much higher return. So that is the way. I start with that. Any company which I start looking, I have started just buying one company which is into the auto ancillary, which is not doing good since last 6-7 years, and that company is still growing. In 2015-16, the P ratio of that company was 32-35. Now it is 14-15. Balance sheet is strong. There is almost zero debt, and people are not expecting anything from the company. So such places you need to find out.
So for analyzing these things, do you think that going through the annual reports of different companies in the same sector and also the conference calls are very helpful?
Yes, those are very helpful. And if you go past 3-4 years down the line, because management at a particular point telling something and what they are doing, what they are achieving. Besides that annual report, you need to see related party transactions, salary of the top management, what kind of salary they are taking, and then their other policies, their strategy. And the more helpful is always you see the competition, what they are doing with against the competition, whether they are doing better than competition or they are not doing better than competition, or whether they are likely to do better than them or not. Because competition, one thing, capitalism is brutal. In the companies main motive is to make money. Investors main motive is to make money. So capitalism is brutal. So you have to compete with your peers in a very subtle manner. Means your strategy, your return on equity, return on capital employed. So basically you have to compare with your peers. If you are doing better than peers in last particular, you can take a period, say 5 years period, what the competition was doing and what the company has done. If company is gaining the market share, if the company is gaining in terms of margin profile, then that company is actually interesting. But you need to understand in depth. Huge money in equity market or better returns in equity market can come through the hard work. People say it's a luck. It's not a luck. Luck is only if you just see a small period, 2, 3, 4 years. But if you want to be a decadal investor, you want to invest for 10 years, it is not luck. It is your hard work, your understanding, your emotional intelligence that plays out a lot. So you have to analyze in detail. Yes.
Sir, according to you, what would be the one of the best strategy to invest into during the starting of bear market? Is it a silver or waiting in cash or something?
Actually, this is a very tough field. How do you know that this is the beginning of the bear market? It is known only in the hindsight. It is never known in the foresight. Because after these events happen, you know that this is a bear market. Because market will take different percentage of corrections from 5% to 50%. You don't know today market is going down, it will go down by 5% or 10% or 15% or 20%. It is known only in the hindsight. For example, we have just made a analysis on that. So as per our analysis, there has to be a larger gap for a major correction. For example, in India, we saw 4 major corrections. One in 1991, other in 2000, third one is 2008, and fourth one is in 2020. So there has to be a gap of 8 to 10 years of a major correction to the tune of 40 to 50%. If the gap is lower, say 2020 and this correction. So in my view, this correction will be around not more than 20% because the gap is just 2 years. So the larger the gap, because people forget what happened 10 years ago, and many new investors also join in the bandwagon. So then they forget, then the corrections are higher. Then when they remember, the correction is not higher. So generally, I put a tweet also. Once in a year, it corrects by 10% approximately. Once in 2 years to 3 years, it corrects 20%. One in 5 years, it corrects 30%. And once in a decade, it corrects by 40 to 50%. That is generally what has been the history. How this will, because history, it just rhyme. History just rhyme. It is not repeated. So you have to see in that fashion. So generally, bear market will be known only when it has already taken place.
Sir, I completely agree about your opinions of the hindsight and foresight and the psychological aspects of the stock market. So how did you navigate the crash of 1999 and 2008, if you can say?
1991, 2000 was one of the worst crash for me because my money went down by in a big way and I was not having quality stocks. Though what happened when I started investing in 94, 95, by the time 2000 arrived, it became multi-bagger portfolio. So even after a huge drawdown, I was happy because after a huge drawdown also, well, I'm talking of drawdown when it was 2000 end, because this correction started sometime in February 2000 and lasted for next 18 months. But the major correction took place generally in the first 4, 5, 6 months. This is the history of the stock market. When the severe bear market will come, within 4, 5, 6 months, it will have major corrections. Later on, there is just a sideways movement or to tire the bull kind of situation. If you take any of the example, 2000, within 6 months, it corrected deeply. 2008, within 6 months, it corrected deeply. In 2020, it's a pandemic situation. Within 2, 3 months, it corrected deeply. Later on, it start moving up or it remain in the sideways zone. So in 2000, my quality of stocks was very bad. I started with Infosys and I reached to the lowest rung of the stocks. Like say Kashyap Redyan, Ram Informatics. You people must have not listened the name of such companies. But after 6 months, I realized my mistake and I sold it. Because of my early entry into 94, 95, I could still make a huge gain, though it was down by 60, 70%. But out of that, one stock was good with me, which was BFL Software. Now it is Emphasis. So anyway, I like that company a lot, and I sold those bad pieces and bought the Emphasis BFL more. So then later in 2001, it went up like anything. So I recovered my huge losses, which I incurred. Losses in the terms of notional losses because my initial capital was small, and by the time it was a good gain in spite of the large correction. So in 2008, I was pretty smart because I saw 2000 crash and pain and going back to lower quality stocks. So 2008, I did not, I was not into bad stocks, so I did not need to sell my stocks. I just kept on holding those stocks, though I could not add because I was not having liquidity that point in time. So I just kept on holding, and within 18 months, my portfolio was at a new high. So it was a comfortable, though it was a short, brief time of pain. In 2020, also my portfolio was pretty good in good companies, and I added some more because of I got a lot of money at that point in time. So 8 was not troublesome. 2000 was very troublesome because I owned all the lower quality stocks. 2008 was okay. 2020 was a wonderful. So learning from my own experience, I could apply it better.
So do you think that the Indian IT mid-cap sector is very overvalued? And even we've seen that many mid-cap and small-cap stocks, though some of them might have good fundamentals, like Mastech gone from around 100, 200 to 3,300 and something, and Birlasoft and others are still haven't corrected much, or in general the sector.
I'm not owning any IT company. Reason being, I find them overvalued because these were trading at 10 to 15p or 17p, and it went to 40, 50, 60p. So I'm not comfortable holding stocks which for say 10, 15p and then goes to 40, 50p. As I said that I rarely buy a stock which is 50, 60x. Only one stock in our portfolio which is 50, 60p, trading at 50, 60p. Because there is a huge growth potential for next 20 years. Otherwise, in entire sector like chemical or IT has now corrected some bit, but I still find them overvalued. So you can take your own call because, as I said, overvalue can become extremely overvalued. That is how market behaves. So you need to take your own call. But in my view, I'm not owning any IT company right now.
Yes, I completely agree that it's really very difficult to find the exact position of the pendulum with respect to stock market. So one student, Ayush Tripathi, is asking, how do you maintain the confidence of your clients during those difficult market positions when when the portfolio went down a lot?
So first thing, what we do, whatever portfolio we have of the clients. So our largest client's portfolio is a multi-million dollar portfolio. And I should not say that we are the captain of the ship. We are holding much more share than our largest clients hold. So basically clients are very comfortable. If I say that whatever quantity you have, and some information is in public domain also, some of my shares in public domain also because I'm holding more than 1% in those companies. So clients are comfortable when they see that fund manager or those who are managing the funds, including my partner, Mr. Rajesh Seth. So when they see that their own stocks are multiple times their holdings, then they are comfortable generally. So there are some clients which are not comfortable. Then we say, even if you want to exit, you exit after 6 months to 12 months. So most of the clients exited. So none of the clients exited during March, April, May, but some exited in October, some in December, and over next few months. So net, if you are captain of the ship, you are owning those companies which your clients are owning. It is much more comfortable for them. But some fund manager, if they are not owning, then it is very difficult because they themselves don't have that kind of conviction. Because you feel pain of a stock or gain of a stock when you are owning those stocks. So we have one formula. We always have a skin in the game. So that helps to us. I don't know how the other fund managers are able to handle this situation, but our style of handling the situation is that, and we ourselves did not sell any stock during the drawdown or fall, so they are comfortable with that.
If any other student also has any questions, they can raise their hands. We will unmute them and they can ask the questions.
I can talk still another 15 minutes because students, those who want to ask, they can definitely ask.
Thank you, sir. So any student has any queries, please raise their hands, or if you feel shy, you can also type in the comments. Both are completely okay. So one student was asking that what are your opinions related to Chinese stocks that are listed on American exchange in the form of ADRs? Like we have seen the massive crash of big tech giants like Alibaba, Tencent, etc. And though there is a doubtful in their reports, financial statements, but they claim that these companies have massive free cash flow, revenue growth, and all the good factors that seems to be a top within top company.
Actually, when there is so much of tussle between the two countries, and when the China narrative is different, one is not sure of what that country will do with regard to businesses or FPI flows. So it's very difficult to predict. So generally, in my opinion, why to enter into such a place or a space where there is no certainty and surety? So it is always better to remain in a sure and certain space. So if somebody want to look for a global investment theme, I think USA is better because their democratic system and the way they have promoted capitalism so far, it is better to look at US companies if somebody is actually interested in international play. In my view, Indian market is good, and we look only in Indian market. We just invest into Indian market. We don't invest into any of the international company. But China is one country which is highly unpredictable, so even people don't know what is happening with the COVID. Their information to the globe is a very, you can say, filtered one by the governments. So it is very difficult to predict. And we all are the small investors. We don't have capital in huge amount so that we can look for global this thing. First, accumulate the wealth. Try to be where you know better, whether it is India or if at all you want to look outside, it is best to look at the American company. So I'm not very bullish on American market because they are having a 10 years of huge bull market. In India, the bull market has just started. So in my view, might be little biased, home biased. So I'm investing only in India, and global is very difficult because geographical risk, currency risk, you are taking so many risks. So you have to calculate those risks, then you can think of.
Sir, I would like to ask a question about what would be your opinion regarding the new age growth stocks in Indian listed on Indian exchanges or startups which are currently profitable in India?
Yeah, that's a very good question. So startups so far has shown higher growth, but many of the startups have not turned into even near to profit. So whenever you smell a profit in any of the startups, you can value that profit or a likely to be profit 3 to 5 years down the line, and then you can assign the PE ratio to that. For example, so far, Nika is one company which is about to show some profits, and but you can always analyze the valuation. So those companies which are into the around the profit or likely to be in profit, those companies one can look at it. But at those companies which are not likely to be in profit, because now the situation has changed in last 6 months, and to access the capital, particularly debt capital, will be difficult because now interest rates are going up. So in my view, look at only companies which are around to be cash flow, because those who will need the capital will be difficult to sail through this rough patch. I believe into the cash flow or a company which is likely to be near cash flow.
Yeah, thank you, sir, for that. And another question which I actually had is that there are many startups. It's a bit related to startups, like some of the startups like Byju's and all those. There are quite a lot of allegations regarding their practices, malpractices. So what would be the impact on them, because it is indirectly related to the shareholder sentiment values as well, because they would not prefer someone to invest in such a company.
Yeah. So Byju's, I also heard a lot of allegations against them. So these are the bull market excesses. Like there had been a huge bull market in startup capital space or venture capital space. A lot of valuations froth has been assigned. For example, see the condition of Paytm. It was listed at 2150. They have given at 2150, listed at 16, 1700. Today it is 500 rupees stock. So such pains will come whenever the froth will go off. So that's why I always say focus on cash flow, value them on a logical, average, reasonable basis, and then invest. That will always help. It is quite possible when the market goes down first time, all the stock may go down, but the first rise will always start with those companies which are generating huge cash flows and those who are at a discount. So if you will focus on companies which are into the cash flow or net profit and at a discount, you are likely to make a huge gain whenever the bull market is start. Maybe 1 year down the line, 2 year down the line, 3 year down the line. It is very difficult to specify the time, but keep always focus on the companies which are into the generation of cash flows.
So what would be your advice to those students who wanted to make their career directly into the stock market or the investment side just after their college and even from the science background? Like what could be their typical pathway for them?
There are three ways. Some people wants to become traders, which is always a very volatile field. Higher the leverage, higher the risk. So trading, from my point of view, one should not try to make it full-time career. Investors can have full-time career, but it takes 10, 15 years, 20 years. It is not either somebody has owned a huge money from their family and they don't know how to invest it. They can become investors immediately. But I think we all most of us belong to middle class family. So in middle class family, you need to create wealth for yourself, which takes minimum 10 to 15 years. After that, by the time you will understand the market or your investment philosophy will be developed, you will be able to understand how much capital you can generate, and so on. So then you can think career as an investor. So far, the investment banking or analyst role is there. There is a very tough competition. So particularly for science background people, so obviously there are a lot of from finance background people. So there's always a tough competition, but one can try for that. One can try for that. The more passionate you will be, sooner or later you will get the job. That is how it works out. So these are three types of careers which one can choose. But most of them would like to become financially independent. That is what now the new concept is. And when you have around say 15, 20 years of annual expenses, net worth, liquid net worth, you can become financially independent. But obviously it will take 1 to 2 decades if somebody doesn't inherit a lot of money. That's the other option.
So one last question, do you think that this currently there is the starting of the venture capital, private equity and hedge fund industry in India, since these industries weren't present earlier in our country in comparison to developed countries, like tremendous growth in the future in these industries?
Yes, it is a very scalable industry. And if I see last 15 years, it has already scaled up, but there will be multiple times growth in this industry without any doubt, because in spite of this interest rate scenario, which is always for a brief period of 1 to 2, 3 years, you will see a lot of capital will flow here. Because what is happening globally, if I see that most of the people who have made money globally, particularly US and Europe, they all want to become investors. That's the only field where your money works for you all the time. Otherwise, how do you make your living? Either you will have to sell your hard work. You are going to your office every day. After a month, you are getting salary, or your money is working for you always. So the concept for coming many decades will be that investors would like to invest money. So investors don't themselves have that kind of skill set or mindset. So they will invest through the help of whether venture capitalist, private equity, listed space, mutual fund, PMS companies. They have very bright future because a lot of money. If you see otherwise in a very simple terms, now a few days ago, capitalization of global equities touched $122 trillion. After every 10 years, this increases a lot because there is a natural growth in equities to the extent of, in a developing country, 10 to 12% every year. Natural growth. This is natural growth. And in a developed world, so for America is showing high growth, you may take 6 to 7% of average growth. So $100 trillion, if it is growing by $6 trillion a year, how much more money will flow into this industry? So there is a huge scope for that. It will grow multifold from here.
I think we can wrap up now.
Yeah.
Overall, on behalf
I'm also tired.
Sorry, sir, for the inconvenience.
No, it's okay.
And thank you for today's session. Overall, on behalf of the entire team of the Finance Club IIT Patna, I would like to thank Mr. Chander Bhatia for such a truly insightful session. I am certain that each and every person in the audience took something very valuable from the session. And I would also like to thank the audience for being so patient and enthusiastic during the entire session. Thank you, sir.
So yeah, I'll just correct. My name is Chander Bhatia, not Chander Bhatia. So I'll just correct everyone. Not an issue. So my name is Chander Bhatia, and thank you so much. And I wish all the young professionals to do very well in their career and as well as into the field of investments. All the best. Thank you so much.
Thank you, sir.